You're about to hear my conversation with Leslie Marks, Chief Investment Officer of Equities with Mackenzie Investments. Today, we're going to explore why equity markets have remained resilient despite oil prices rising over 50% over the last 3 months. We'll also talk about the big numbers of data center capex and the impact of that capex on the real economy as well as equity markets. And we'll close our conversation talking about Canadian equities and the ability of value as a style factor to continue to outperform. This podcast is for informational purposes only. Information relating to investment approaches or individual investments should not be construed as advice or endorsement. Listeners should seek professional advice for their situation. Welcome to The Invested, a podcast from Mackenzie Investments. My name is Rajan Bansi, Head of Portfolio Construction. Today, I'm joined by Leslie Marks, Chief Investment Officer of Equities for Mackenzie Investments. Leslie, thank you for joining the podcast today.
Thanks for having me, Rajan. I'm joining you from Dublin.
Wonderful. It looks like spring has sprung in Dublin as it is starting to across the country in Canada. It's the middle of May, so it's about time. And with it being the middle of May, I thought the right place for us to start our conversation is with respect to the resilience of equity prices globally, really, after 3 months of elevated oil prices after the war in Iran, as well as the blockade in the Strait of Hormuz. What explains the resilience of equity markets from your seat?
Well, Rajan, I'm glad we're not talking about the weather because that would just be depressing. It certainly has been a slow start to the spring, so we're all looking forward to better weather. But on a more upbeat note, as you noted, it's been a very strong market when it comes to equities. And people have been surprised by the resilience of equities in the context of elevated oil prices. And really, I would say the short answer is earnings and AI matter much more than oil prices. Of course, when you look at the calendar here, midway through May, we're most of the way through Q1 reporting season for earnings. And we've seen estimates move. If I think back to when I was with you on the podcast early in the year, I think we were looking for 14 or 15% earnings growth, both in Canada and the US. And that number today is, wait for it, it's a bit of a mic drop, in the 25%
Wow.
range. So I don't know a time when I've seen in such a short period of time earnings to be more positively revised upwards. Here we go. So now, where is this coming from? Primarily, this is due to, I would say, the technology sector and, unsurprisingly, energy or expectations for energy earnings growth. One more thing I would say that's notable on the earnings growth side is when you look at, because you connected, stock prices to oil prices, and when you look at the makeup of the S&P 500, the actual exposure to higher oil prices is a lot lower than it has been in previous cycles where we've had spikes in oil or shocks in oil. Obviously, that's because of the role of TMT and the exposure in the S&P, which is about 50% of S&P earnings. So, more on this. The WTI right now is up about 55% since the end of February, since the war in Iran began. The Nasdaq is up almost 17% and the S&P up 9. So, you can see that technology there has played a much bigger role in the move that we've seen. The last point I'll make is, we've talked a lot about Mag 7 in previous podcasts, but this is a little bit different, what we're seeing here. And I actually looked this morning, NVIDIA of all stocks is only the 30th best performing stock in the S&P 500 Infotech Index. So the drivers are really more related to some of the AI infrastructure plays, semiconductors, of course, memory, storage, and those companies that are really not benefiting from these trends are those traditional software as a service companies like Salesforce, Workday, names like Accenture. They've really been laggards. So it's been a fairly concentrated rally in equities, but not in the places that we've been talking about over the last few years, that being the Mag 7.
Those are some phenomenal numbers you just dropped. NVIDIA, 30th best performing stock. Would have thought it's higher on the list. TMT representing 50% of the NASDAQ, but the number you opened with really caught my attention. Earnings growth up 25%. That's unbelievable. Not sure I personally can recall a time that we've seen such earning growth. So, begs the question though, that's the earnings that we're seeing recorded right now. What's the backdrop for corporate earnings through the rest of 2026, given, of course, markets are forward looking?
Absolutely. Well, first of all, I've also seen statistics that Q1, this won't be surprising in that context of rising earnings expectations for this year. And by the way, that number was the projection for all of 2026. But more than 80% of companies beat earnings expectations in Q1. So a very strong reported earnings period. Now, let's double click on that because I talked a lot about technology and the role of technology and where the earnings growth is coming from. If you actually look at non AI related earnings and non energy related earnings, we actually are seeing a lot of earnings expectations being cut. We talk a lot about the K shaped economy. I'm sure our listeners have heard that many times from speakers. And usually the context is about the consumer, who's benefiting from what's happening in the economy. But overall, the economy is also K shaped. And so the beneficiaries are from this sort of earnings growth are sort of the first and second and third derivatives of AI investment. So obviously the emphasis is on data centers and what it takes to build a data center. And so some of the obvious beneficiaries are in the semiconductor space, but also construction, engineering, the hard materials, resources that are needed to build out these data centers. So there are lots of areas of the economy that are benefiting. But the converse to that, and if you take it, into the higher oil prices world, is there's lots of places that aren't doing well in the economy, and that's kind of the lower part of the K. You think about travel, you've seen airlines cutting their guidance or not even giving guidance for the rest of the year because they can't keep up with higher oil prices, cutting their schedules. Cruise ships, recently with the viruses that we're seeing on cruise ships, like that impacting travel, lots of uncertainty about here I am sitting in Dublin. I'm supposed to come home tomorrow. I think my plane will be, able to refuel itself. But 3 or 4 weeks ago, we heard that there was a chance that jet fuel would be severely depleted in Europe because of the closure of the Strait of Hormuz. Yesterday, I read that Cuba has basically run out of oil. So, there's lots of areas that are certainly being impacted in a negative way here in that lower part of the K. And so the outlook for earnings growth is quite strong, but not everyone will benefit from that strength in earnings growth. The last point to make on earnings growth is, we know where earnings come from. Obviously, they come from top line growth, but also from margins. And what we have seen is pretty attractive or outsized profit margins. I'd say near record profit margins right now across the board. And when you get to those high levels of margin, it's a bit of a marginal story in the sense like how much further can you go in growing margins? And the big story around that is what will be the productivity that comes from all of us, in our business and everyone's business implementing AI as a productivity driver across all of our companies.
Very good. Leslie, you've taken us through the impact of a couple of things that have been higher oil prices. You've talked about higher earnings. There's something else recently that's been higher, and that's been bond yields in the US. We've seen ongoing upticks in the 2, 5, 10, 30-year bond yield. I think the 30-year crossed 5% this week as we're chatting. Does any of this concern you from your seat as CIO of equities?
I've been thinking a lot about bond yields as well, which I mean, it's not something that an equity person often says, but I think you're right to point out that this seems like a bit of a disconnect. The bond yields are reflecting concerns around inflation. They're also reflecting a shift, across the curve and on the shorter end in the thinking around easy monetary policy. Again, if I go back to the beginning of the year, that was certainly part of our investment thesis driving a positive view towards equities was that we expected to see the Federal Reserve to be easing this year. Well, that looks, fairly firmly off the table right now. And now the expectation is by the end of the year that we actually may see a rate hike. So inflation is no joke. It's certainly getting priced in across the yield curve. There's also fiscal concerns holding yields higher in the long end. And when we think as an equity investor around, the equity risk premium right now, when you look at the earnings yield and compare that to the 10-year, which is at about 4.5% today, you can see that there really isn't much of an equity risk premium. So that's not exactly a bullish sign for equities from a valuation perspective, but that can, exist for a long time. So it's not a sell signal either. But one thing I think that is positive is I was looking today at the last time that the 10-year traded at a 4.5% yield. And that was actually around May of last year, a year ago. And so the S&P 500 has obviously had a great move. It was 26% lower a year ago. And I just wanted to put that into context to say, like, should we be concerned at the level that the S&P 500 is today versus where it was the last time? Yields were at 4.5%. And I'm going to bring us back to this earnings growth expectation because, we would have been expecting much lower earnings growth a year ago at this time for 2026. And so it is very important to acknowledge again that sort of 25% earnings growth expectation that we're seeing right now actually can justify the move that we've seen in the S&P 500 from those levels. So I actually think it's a fairly balanced picture, but I do think that the bond market is pricing in a bit of a different environment or outcome when it comes to inflation, more sustained inflation, and thinking that inflation is going to be more of a problem than the equity investor is. I just want to make one more point. You and I were talking a little bit before we started about today being May 15th. I believe this is Kevin Warsh's first day on the job. I don't know what that means if he sort of enters the building and what that handoff is like. Former Fed Chair Jay Powell is staying in the building as a governor, as far as we know, right now. And he has some different views. He's been seen as being a little bit more dovish. I think that's going to be a problem in this environment with higher oil prices. And that's why the futures are not pricing in rate cuts for this year anymore. So we're going to see some really interesting dialogue coming out of the next meeting in the middle of June from our new Fed chair, Warsh.
Very good. Earlier in our conversation, Leslie, you made reference to AI, specifically the impact that we're seeing of CapEx on data centers and overall growth in the economy and earnings specifically. Seems this is a little bit beyond or a lot beyond just data centers. You made reference to construction and other parts of the economy. Can you contextualize the impact that this build out is having on equity markets?
Well, the latest numbers that I've seen are about $800 billion combined capex for the hyperscalers. And what's been interesting is this has been a headwind for them, or was a headwind for them, I should say, earlier in the year. We really saw some of these companies like the Microsofts, Metas, like underperforming the broader market. And so I think what the market was really concerned about was these are companies that have traded at premium multiples because they have very high free cash flow generation capability. And so once you start, pouring all this capital into literally the ground, that no longer exists. And so, when a company becomes highly capital intensive, it typically trades for a lower multiple. So to contextualize this 800 billion, this is about double what they spent in 2025. And Rajan, what's 400 billion dollars between friends? It's a pretty material increase. This is a lot of money. And so we as investors are looking for the payback and what's the revenue that is showing up for these companies as a result of all of this investment. And reality is what we saw in the first quarter was actually some really impressive growth. Revenue is starting to show up, but this has to continue and it has to continue to grow given the high amount of spending that we're seeing. In general, I would say these companies are not the free cash flow generators that they once were. And I think we're going to get into a winners and losers scenario. And that's what the market is saying by bifurcating performance. You've got Alphabet as of today up about 30%, or Google year to date, and Microsoft down 15%. So the market is starting to really vote on who the winners will be here. There's big differentiation in strategy amongst these hyperscalers.
Now, for much of our conversation, we've been focused on the United States. What of Canada, with the heavy composition of the index being in financials and energy? What have you seen thus far in 2026? And at this point in time, what's your outlook?
Well, 2026 in Canada, like many markets, has really been the tale of two markets. If we were talking on February 25th, we'd be only be talking about gold and what that's doing to Canadian stocks. Fast forward here to middle of May, and now things have really changed. I would say as soon as the war started and energy really took over that leadership position for the TSX, and conversely, materials started to really sell off, gold specifically, the commodity and the companies. So Canada's been interesting. The net result is that the TSX is basically flat since the war started after having, a lot of leadership, around the world compared to other markets. Energy is up about 11% and financials up 6, and that's offset by materials, which are down 13. If you look across the Canadian market, we're very limited in our AI exposure. We don't have the big semiconductor and memory plays that you see in the US and Asia. And sadly, we do have some heavyweights that would be considered more in the AI losing side by investors, names like Thomson Reuters, CGI, Shopify. So those big weights have been a headwind for TSX performance. I want to spend a couple minutes on the sectors that you specifically asked about. So, first of all, energy, obviously a strong performer in Canada. Cash flow will be extremely strong. It's a big contributor to the expectation for strong earnings growth. And we're not seeing companies reinvest so quickly that sort of opens the door to greater return of capital to shareholders, either through dividends or buybacks. And so we think that even if the conflict in Iran ends tomorrow and the Strait of Hormuz reopens, we think that energy prices continue to stay high. And, another element which seems to be really sealing the news flow in Canada is slightly political, but, global demand for Canadian energy as a secure supply source needs to really be part of one's investment thesis. We're looking at potential to add pipeline capacity. Just yesterday, our Prime Minister Carney, announced more flexibility for power generators to use natural gas as part of his plan to double Canada's electricity generation by 2050. So, there seems to be a lot of progress also being made on the industrial carbon price negotiations with Alberta as well. And so I think the energy story for Canada is not going to go away, even if the Strait of Hormuz opens. So I like that story. Turning to the other big sector in Canada, Canadian financial strength, it's really been driven more year to date by non-bank financials than the banks, so to speak. But the banks are the heavyweight, and they are generally part of almost every Canadian investor's portfolio. There may be some headwinds on the retail banking side because of mortgage rate resets and weakness in the Canadian economy. The Canadian economy hasn't been that strong, but the offsets to that are strengthened wealth management. Strong equity markets mean asset growth and optimism. People want to invest out on the risk curve, so more investment in equity, which tends to be higher margin. And the capital markets revenues are strong, good, strong trading revenues, underwriting. There's a strong IPO pipeline. Volatility generally helps trading revenue. So, the energy story is more clearly positive for us, but Canadian financials could do well here as well. I don't see that as the top performing sector for Canada, but I'm not concerned about it.
Excellent. Leslie, for my last question, I'm going to turn to style. We've talked a lot about geography, but what of style? My understanding is through much of 2026, value has performed quite well versus other styles, specifically growth. What's your view on what that could look like through the rest of the year?
The value story for us was pretty clear. I mean, the focus on financials with a dovish central bank backdrop or environment, as I mentioned, all the aspects that would be boosting Canadian banks, we thought was part of the global financial story. Gold, hard assets, some of these sort of more traditional value assets. The investment thesis was fairly straightforward starting the year. I'd say now it's actually a little bit more nuanced. Value has continued to do well, but it has moved into other areas like what I would call sort of the value technology space, hardware, storage, memory, semiconductors. These are not the low capex, high ROE businesses like the SaaS companies or software as a service companies that have dominated the growth indices. So these are the names that have traditionally occupied the value space. And I think there's still a very strong fundamental story here for value names. But this is a very nuanced discussion because the value names may actually shift. Value and growth indices are relative to each other. So you could start to see these value names actually shift to become the new growth names as, such the growth names become more value names. So it's hard to sort of generalize and say, these are the names in the value index that will continue to do well. I think we need to look at this more about what are the names that we're looking at that have strong tailwinds as opposed to those with headwinds. Those have traditionally been thought of as value, but watch the shifts between the two indices.
Very good. Fabulous. Leslie, thank you so much for making the time to chat with us today, and from Dublin, no less. Thanks again. Look forward to having you back on the podcast sometime soon.
Thank you, Rajan. A pleasure to be here.
The content of this podcast, including facts, views, opinions, and recommendations, is not to be used or construed as investment advice and is not an offer or an invitation to buy or sell any security. The content of this podcast should not be relied upon for any purposes, and Mackenzie Financial Corporation is not responsible for any reliance upon it. This podcast includes forward-looking information that reflects our current expectations or forecasts of future events. Forward-looking information is subject to risks, uncertainties, and assumptions that could cause actual results to differ materially from those expressed herein. Our views are subject to change based on market conditions. Commissions, trailing commissions, management fees, and expenses may all be associated with mutual fund investments and exchange-traded funds. Please read the fund facts and prospectus before investing. The indicated rates of return are historical annual compounded total returns, including changes to unit values and reinvestment of all dividends or distributions, and does not take into account sales, redemptions, distribution, or optional charges or income taxes payable by any security holder that would have reduced returns.